Hello there and welcome to my channel. In this video, we are coming to learn how to prepare and present a set of financial statements according to IFRS standards. Now, if it comes to the preparation of financial statements and their presentation, we refer to IAS 1, presentation of financial statements, as for guidance. So that is what we refer to, or that's the standard that guides us when we want to present a set of financial statements according to the IFRS accounting standards. So if this is your first time on my channel, kindly subscribe to the channel and consider liking the video if you find it useful. Alright, now when we come to IAS 1, presentation of financial statements, it actually gives us a guidance as to how to present the financial statements, the content, the minimum content requirements, and other compliance requirements with IFRS standards when we are preparing the financial statements. Now, according to IAS 1, there is a set of what we call a complete set of financial statements. Now, according to the standard, a complete set of financial statements should comprise at least 1. A statement of financial position at the period end. 2. A statement of profit or loss and other comprehensive income presented together or separately for the period ended. A statement of changes in equity for the period. A statement of cash flows for the period. Now, cash flow is covered by another standard, a separate standard, IAS 7, statements of cash flows. So when it comes to the presentation and preparation of statements of cash flows, IAS 7 is a standard that covers it. The reason is that for the other financial statements, they must comply with the accrual accounting concept, which says that transactions are supposed to be recorded as and when they occur and not when cash is received or paid. So that is the reason why a separate standard is dedicated for cash flows, which is cash based, is cash accounting, which is in contrast with the accrual basis of accounting. All right, so that's just by the way. So we have a statement of cash flows for the period, and then also you should have notes comprising a summary of significant accounting policies and explanatory information. And then finally, you should have comparative information as well as a set of a statement of financial position at the beginning of the earliest comparative period where an entity applies an accounting policy retrospectively or makes a retrospective statement of items in the financial statement, or it reclassifies items in the financial statement. So that is a kind of a third statement of financial position that a firm should prepare when it does those requirements that I mentioned. Alright, so in this video, what I want us to learn is how to prepare the financial statements. So we have a question here, and this is relates to Freedom PLC for the year ended 31st March 20x3. So we have sales, cost of goods manufactured in the year to 31st March, distribution cost, administrative expenses, reconstructing costs, interest received, loan notes paid, land and buildings, plant and equipment, accumulated depreciation for buildings and plant and equipment. We have investment properties at market value, inventories at 31st March, trade receivables, bank and cash, ordinary shares of $1 each, fully paid, share premium, revaluation surplus, retained earnings, ordinary dividends paid, 7% loan notes, trade payables, proceeds of share issue. Alright, so that's the trial balance. Then we have an additional information. So 1, the property, plant and equipment are being depreciated as follows. So that's information relating to depreciation. You have buildings 5% per annum straight line, plant and equipment 25% per annum reducing balance. We have depreciation of buildings is considered an administrative cost, whilst depreciation of plant and equipment should be treated as a cost of sale. Then on 31st March 20x3, the land was revalued to $24 million. Income tax for the year to 31st March is estimated at $976,000. Ignore deferred tax. Alright. The closing inventory as at 31st March were $5,180,000. An inspection of finished goods found that a production machine had been set up incorrectly and that several production batches which had cost $50,000 to manufacture had a wrong packaging. The goods cannot be sold in this condition but could be repackaged at an additional cost of $20,000. They could then be sold for $55,000. The wrongly packaged goods were included in closing inventories at their cost of $50,000. Right. Then we have a fifth information. The 7% loan notes are 10 years loans due for repayment at 31st March 20x7. Interest on these loan notes need to be accrued for 6 months to 31st. All right. We have 6. The restructuring costs in the trial balance represents the cost of a major restructuring of the company to improve competitiveness and future profitability. No fair value adjustments were necessary to the investment properties during the year. And then lastly, during the year, the company issued 2 million new ordinary shares for cash at $1.2 per share. The proceeds were recorded as proceeds of share issue. Alright, so we are required to prepare the statement of profit or loss and other comprehensive income and the statement of changes in equity for the year ended 31st March 20x3 and the statement of financial position as at that date. Alright, so this is the question we want to use to solve our. Now, when it comes to the solving of a set of financial statements or published financial statements, it is always advisable that after reading the question, you quickly draw a pro forma financial statements. So based on the information you are given, you use the items in the question to draw a pro forma financial statement. So this is what I mean. So after reading the question, you know some of the items in the question, or you have come across all of the items. And so what you have to do is to draw up a pro forma financial statement. So first of all, I have my the name of the company. Now all of these are requirements by IAS 1. So we're supposed to start by the name of the company, followed by the heading of the particular financial statement you are preparing. So the first one you are preparing is the statement of profit or loss and other comprehensive income for the year ended 31st March 20x3. Now, for simplicity's sake, that's why I'm preparing the statement of the financial statement on the same sheet. Alright, so the best way of doing this is actually to present them on separate sheets, and that is a very good presentation. Alright, so we have our statement of profit or loss and other comprehensive income, and this is the normal trading profit and loss account that we know. The only thing is that we have to present it in accordance with IAS 1. So here we are trying to prepare the statement according to IFRS accounting standards. That's what we are doing here. So whatever you are doing, you want to present the statement in accordance with the standard. So according to the standard, always start with sales or revenue. In this case, our question states sales, so we are going to use sales. And then what we do is we less cost of sales, less our cost of sales, and then when you less cost of sales, we have our gross profits. have our gross profit, and then we are going to have distribution costs. So I'm going to leave a link to download the question in the video description. So kindly download the question so you can follow along, so that I don't have to be going back and forth. So as we can see, this is sales, this is cost of goods sold, forming part of our cost of sales, distribution cost. So it is the information within the trial balance that I'm using to prepare my statement of profit or loss and other comprehensive income. And that's what I'll be using for the statement of financial position as well as the statement of changes in equity. All right, so we continue. So we have administration. So we have administration costs, expenses. We also have restructuring. The restructuring costs. All right, so now we have our set of our pro forma financial statement of profit or loss and other comprehensive income intact, and you are going to continue and do same for the statement of financial position. So this is a way of doing it so that it becomes very easier for you. So you just read through your trial balance, and then you pick the items that are likely to feature within your financial statement. Now this is Excel, and so if I make a mistake, I can actually correct it by just, or if I skip an item, I can just correct it by inserting a space. But when you are doing this manually, if you are writing with your hand, what you have to do is, perhaps when you are not sure about all the information you have, you can actually leave spaces between the some of the lines so that you can allow for any corrections when you start working on the financial statements. All right, so we continue to the statement of financial position, and then we are going to draw up the statement of the pro forma statement of financial position. So we have our statements of financial position. As at 31st March 2023. I'm putting and align this. And then lastly, we are going to do the statement of changes in equity. So we have our statement of changes in equity for the year ended 31st March 20x7, 20x3. So when it comes to the changes, the statement of changes in equity, we are talking about the equity portion of the business. So all the equity items within the company, within the financial statement or the statement of financial position, is what we bring under the statement of changes in equity. So what are the items within the equity section? So you have share capital, share premium, retained earnings, and then the revaluation surplus. So these are the four main or major components of equity, and that is what we actually include within our statement of changes in equity. So that's exactly what I'm coming to do here. So we present them in a columnar form. Usually they are presented in a columnar form. So I'll have my share capital. All right, so we have our pro forma financial statement set up, and we are ready to insert the figures for each of the items that we have within our financial statements. So we start with sales. Now, one thing you must know about the published financial statements is that each of the items within the financial statements are guided by IFRS standards. And that is why I captioned this video, preparation of financial statements according to IFRS standards. So each of the line items here fall under a particular IFRS standard. For instance, sales. When it comes to sales or revenue, we refer to IFRS 15, revenue from contracts with customers. So that is the standard that guides the valuation of revenue, the amount of revenue to include in our financial statements. So what I'm trying to say is that you should be aware, or you should know, that some of the key standards that guide the preparation of financial statements. So there are some items that are always there. For instance, revenue. So you should be conversant with IFRS 15. And another one is property, plant, and equipment, that is IAS 16. You should be very conversant with IAS 12, that is income taxes. You should be very conversant with IAS 37, provisions, contingent liabilities and contingent assets. You should also be conversant with investment properties, inventories, IAS 2. Investment properties is IAS 40. You should also be conversant with let me see. So these are key IFRS standards that you should know at your fingertips before you can be able to confidently solve questions on financial statements preparation, because you are actually preparing the financial statements in accordance with those standards. All right, so that is just a bonus tip I'm giving you. All right, so we have sales. For our question, sales has been given directly. So you are going to input the sales figure just as it is, as given in the trial balance. So our sales figure is 124,900. And for our cost of sales, we need to calculate it. So we have to, before that, let me align this to the right center. Okay. So for our cost of sales, let's go to the question, and we see cost of goods manufactured in the year to 31st March. And we also have some of the items that comes into cost of sales. So we'll come to the trial balance, and then we'll look at every item that affects cost of sales. So the first one is the cost of goods manufactured, which is a cost of sale item. And we also have inventories, opening inventories, that is 31st March 20x2. We also have our closing inventories within the additional information, which we have here, the closing inventories. And this, we are supposed to apply the standard IAS 2 inventories to be able to arrive at the cost that we must include as our closing inventory. Okay. So those are some of the adjustments we need to make to our statement of our cost of sales to be able to arrive at our cost of sales. And then also, we have been told that the depreciation of buildings is considered as an administrative cost, whilst depreciation of plants and equipment should be treated as a cost of sale item. So the cost of sale has also been affected by depreciation. So what we can do here is that we come here and then we write workings. So we have workings. Workings is always part of the work. So you always have workings. Sorry. So the first one is we are just going to write expenses. And I'm going to do it in a columnar form. So my first expense item is cost of sales, which I shorten as COS. The second one, now reading through the question, you realize that administrative cost has also been affected by depreciation. And so which means that the administrative costs has to be adjusted for. So I'll also bring that here, admin expense. So I'll just write admin expense there. So what do we have to do here? So to make life easy for me, I'll just write per trial balance. And what is the cost of sales figure per the trial balance? So that is the cost of goods manufactured. And that is what we have as 94,000. So I'll come here and write 94,000. And then my administrative cost is 16,020. So what I can do is I have to cut this, paste it here. So I can insert my dollar and then I can also center and then after that we are going to add my opening inventory, which I have in my trial balance. So this is a way of doing your work, making it very simple for yourself. So I have my opening inventory, and that is 4852 on as given in our trial balance. And for admin, we don't have anything like that. So come here and open it a bit. And then I'm going to have my depreciation here. And I'm going to bring semicolon for building. So we're going to have for building as well as for plants and equipment. Now the depreciation is actually calculated from the PPE schedule, and so I can come here and prepare my PPE schedule as well. So I have my property, plant and equipment schedule, and that one too is prepared in columnar form, in taking into account the number of property, plant and equipment or fixed assets that we have, or non-current assets that we have within our question. So for our question, we have land. So let's go back and see. So we have land and buildings, which are supposed to be separated because land is not depreciated, but buildings are depreciated. So we have to separate them within the PPE schedule. Then we also have plants and equipment. So there are actually 3 property, plants and equipment items within our question. So I'll have my land, I'll have my building, and then I'll have my plants and equipment. And then I'll have a total column. So I have a total column here. And this is also, bring my dollar plus the sum. copy it to the right. All right. So with the PPE schedule, we start with the we are going to start with the balance brought forward. So balance brought down or balance brought forward for each of the items. So the balance brought forward can be found within the trial balance. So for land, you have been given the value for land to be, so this is the cost. All right, so this is how the PPE schedule works. So we'll actually have costs, and then we also have depreciation. So we are going to look through the trial balance, and then we are going to fish out the cost of the assets. For land is 20 million, whilst buildings is 30. So this is 50,300,000. So 20 million out of the 50,300,000 consists or relates to land. So our cost for land is 20,000, and that of the buildings is 30,300. And then we also have our plant and equipment. Plant and equipment will be 3,720. So I'll come here, and the balance brought down, you have 20,000. For building, it's going to be 30,300. And then for property, plant and equipment is 3,720. And then I'll have my total here, alt equals, and then I have my total there. Then the next thing we bring here is if there is any additions. If there is any addition to our PPE, or if there is any prior year adjustments, what we do is that we would take care of all those items. So addition to PPE, if we buy any land during the year, or any plants and equipment during the year, the value would have been added. Or if there is any prior year adjustments which we are supposed to correct or adjust for the cost of the item before we apply the current year's depreciation, we will do everything in this particular schedule. But in our case, we don't have any of those things, and so the value of the assets remain the same. So we have 20,000 for, so this is going to be equal to this, and I'm going to copy to the right. So Control R, then I'll bold in it. So those are our cost figures for our property, plant and equipment. Now we have the depreciation. Depreciation is the same thing. We have our balance brought down, which is actually the accumulated depreciation carried forward from the previous year. So from our question, our accumulated depreciation for building is 6060, and then for plant and equipment is 1670. So I'll come here, you have 6060, and we'll also have, sorry, so this is actually for building, so I'll cut it, paste it here, and therefore property, plant and equipment is 1760. Is 1670, sorry, and I have my alt equals here, I add it. And then the next thing is the charge for the year. The charge for the year. Now, when there is a prior adjustment for the cost, that means that depreciation might also be affected. So we'll also come and adjust for any prior year adjustment that we make to the cost. So we'll adjust for the cost elements as well as the depreciation elements. All right. So that is it. So we have the charge for the year, And for the charge for the year, for our land, it is not depreciated. Then we have for our building. So for our building, we are told that it is depreciated at 5%. So this amount here is going to be depreciated by 5%. So I'll have my equal to sign, and then I'll write this multiplied by 5%, which is 0.05. So we have that. And then also for my property, plant and equipment, it is this amount less our accumulated depreciation from the previous year before multiplying the results by the rate of depreciation. I'm going to explain that in a jiffy. So the rate of depreciation is 25%. So that is going to be 0.25, and there we have it. So let me actually put this in brackets because I think it's not calculating well. You have 513. Now, the reason why I did this, as we have in the formula bar here, is because the plants and equipment are depreciated on reducing balance method. So they are depreciated on the reducing balance. So with the reducing balance, we calculate the depreciation on the cost of the assets less the accumulated depreciation. Okay. So that is the difference between the reducing balance method and the straight line method. The straight line method, we apply the rate on the cost of the assets. All right, so I can copy my formula down, and that is our total. So we'll have our total depreciation, and that is going to be equal to the sum of these two. So that's going to be the sum of these two, and I want to make it okay. So I'm going to copy the formula across using Control R. And then with that, I'm going to have my bolding it. And then we can now calculate our carrying amount. The carrying amount is the difference between the cost and the total depreciation. So we have our carrying amount here. And I'm going to have for land, it is going to be the 20,000 we have here. And then for my building, it's going to be this 30,000 minus the total depreciation. And then I can copy the formula across. So this is our property, plant and equipment schedule. So that is our carrying amount right there. Then we insert border. So that is what we have right there. Now this charge for the year is what we are adding to our cost of sales. So for the plant and equipment, the 513 here is what we are adding to the cost of sales. So we come to our cost of sales. So we have depreciation for building, which is supposed to be allocated to the admin expenses. So I'll come to my admin expenses, and I'm going to link my charge for the year for building. And then when it comes to the cost of sales, I'm going to link the 513 that we have here. So that this is very dynamic. Whatever changes I may make on this PPE schedule is going to reflect in our calculations as well. All right. So you must learn to use formula referencing when you are preparing your financial statements using a software such as Microsoft Excel. All right, so we have that. So, and then the last thing here we can do is to actually bring our closing inventory. So I can have my closing inventory, and now when it comes to the valuation of closing inventory or inventory, IAS 2 inventories prescribes that inventory should be measured at the lower of cost and net realizable value. So what it is saying is that when you are giving information about inventory or cost information and other information about inventory, we should assess the inventory, assess the cost, and then the net realizable value. The one which is lower is the one you use to value your inventory. So we have our inventory information here. The closing inventories were 5,1. So removing the 3 zeros, we have 5,180. An inspection of the finished goods found that a production machine had been set up incorrectly and that several production batches, which had cost 50,000 to manufacture, had the wrong packaging. The goods cannot be sold in that condition, but could be repackaged at an additional cost of 20,000. They could then be sold for 55,000. The wrongly packaged goods were included in closing inventories at their cost. So let's quickly go to workings number 3, and I have inventories. So I have inventory, and what I'm going to have here is, so let me bring the 3 zeros. So when it comes to inventory valuation, I'll have my costs, the cost of the inventory. So let me cut this and put it here. So I'll have my costs, which is 5180, and then we are going to have, so if you want to understand what I'm coming to do here, then it is advisable that after this video you go and then you revise your IAS 2 standard, IAS 2, which is inventories. So we have our cost there. Now, what is our net realizable value? The net realizable value is the the price less the cost to sell. The price, the selling price less the cost to sell. So what we want to sell our item at 55,000. So after we have repackaged the item, we can sell it at 55,000. So I'll come here and then, so we have what? Cost to sell, and we'll have I'll bring my equal to sign, and then I'll bring brackets. You have to pay very keen attention to what I'm coming to do here. So we have the repackaged item inventory being sold possibly at $55,000. So I'm going to have my selling price there, 55,000, and then I'm going to, what I'll do is that this is the cost. So we know that to get the amount to realize for a particular item, it is the selling price. The amount we are going to realize is actually the net amount. That's why you call it the net realizable value. The net realizable value. So that's the amount you are going to use to sell the asset. So this is the cost of the asset. This is the amount we want to sell the asset, 55,000. We repackage the item at 20,000. However, before the repackaging, it was already costing 50, and so we would have come here and write 20 and then 50 again. I'll close my parentheses, I hit enter, and we have 15. So this 15 here is the cost to sell. So that's the cost to sell the asset. So that's the cost to sell the asset. And then I can add it to my cost, the original cost of the inventories. And that is going to be, so I have alt equals, I'll click enter, and that is my net realizable value. That is my net realizable value. And when you compare these two figures, this is the lower. And so I'm going to pick this for my inventory valuation. So I'll come here, and for my closing inventory, it's going to be equal to this particular value here, 5165. And then I can add my items together. So alt equals, I can, holding my shift, I can select the entire values here, and then I'll hit enter. Then I can copy it to the right. So this is closing inventory, and it's supposed to be negative figure. So negative 5160. Make sure it's working. All right, so we have that day. So this is our cost of sales. Now this is how tedious the preparation of financial statements is. So you have to, this one I'm trying to explain, that is why it's taking long like that. But actually this question is supposed to take you less than 35 minutes to be able to finish. All right, so but because I'm explaining some of the things, that's why it's taking longer than we can imagine. All right, so I'll come to my statement of profit or loss, and then I'm going to link my cost of sales figure, and this is supposed to be negative, so I can add them together. All right, then our gross profit is going to be the addition. All right, then we have our distribution cost, that is direct from our question, and that is, so let's go to distribution costs, and that is 9060 given in our question. So I'm going to insert the other figures, 90, 60, and all of these are supposed to be negative numbers. So we have negative 60, we have negative, plus negative admin expenses. So I'll come here and pick my admin expenses of 17,353. I have my negative for restructuring costs, which is 121. Our question, for interest received, is directly from our question, and that is an income. So it is at the credit side of the trial balance, so it is an income, 1,200. So we have 1,200 there, and I can now calculate my profit before interest and tax. So I will have sum equals sum, and then I can sum up all of these up to my gross profit. So I can actually sum these items together. So after summing them together, we have our finance costs, and that is going to be equal to our interest on the loan. So that is 7%, 7% on the 18,250. So I'll come here and we'll write 7. So that is 18,250 multiplied by 7%. That is 0.07. Sorry, I didn't bring my equal to sign. So let me bring my equal to sign, then I'll hit enter. And this is supposed to be a negative figure as well. So negative. Then when I add these two together, so I'm going to have equals this plus this together, and that is what we call the profit before tax. So this is our profit before interest and tax. We have less our finance cost or the interest, and so we have our profit before tax, and then we are going to less our income expense, and that is from our question. For income tax for the year is 31st is estimated at 976,000. So 976. I'll hit enter there, and let me put it in brackets as a negative figure. And so our profits for the year is going to be the addition of these two. So equals this plus this. So we have 2931, and then we have our other comprehensive income, and the other comprehensive income here is the revaluation surplus. Now we have a revaluation surplus which we haven't dealt with in our PPE schedule, which means there is a bit of work to be done. So the note 2 says that on 31st March 20x3, the land was revalued to $24,000. So it means there is a revaluation. How much is our land? Our land was costing 20,000 at the end of the year, and now we have revalued it to 24,000. So a revaluation surplus of 20,000 has been added. So our revaluation gain is 4,000. Is 4,000. Then we have to add it to our profit, and so our total comprehensive income for the year is going to be equal to our profit for the year added to the revaluation surplus, and that is 6391. So I can highlight that, and then I can also insert some border to make my work very nice. Come here, insert a border. Also come here, insert a border, bolding this figure, bolding this figure, bolding. Okay, so that is what we have for our total comprehensive income. Let me double underline that. Then we continue to our statement of financial position. We have interestingly, we have done most of the work already, so we are just going to insert the figures. So for our property, plant and equipment, we are going to just do a little bit of adjustment here, and we can continue. So this amount is actually supposed to be 24,000 and not 20,000. So I'm going to insert a line here, and I'm going to call this revaluation revaluation gain, and that is actually the balancing figure. But for that, let me remove this border here, so no border for now, and the border should rather be here. All right, so we have our revaluation gain, and that is actually the balancing figure 4,000, and these ones remain the same. So this is actually 24,000. So we have that, and my border should extend to that place. So that is our carrying amount for the year. So this figure here is wrong, so we are going to have equals the addition, sorry, so I'm going to have alt equals, and I'm going to add all of those together. So that is our balance for the property, plant and equipment, and it is this figure here that we are going to use under property, plant and equipment within the statement of financial position. So I'll come here and then equals, and then I'm going to link this figure here. And then we have our property, plant and equipment. We have an additional information on our property, plant and equipment. That is additional information 7. No fair value adjustments were necessary to the investment property. Okay, so according to IAS 40, investment properties are measured subsequently at cost and then at fair value. So this one, there are no fair value adjustments, so we are going to use the figure straight away in our trial balance. So that's 24,000. So I'll come here and write 24,000, and that is it for our non-current assets. I can sum them together, alt equals, and I have that. And insert a border here, and then we continue to our inventories. For our inventories, we have the closing inventory, which we have already calculated. So I'll come to my closing inventory right here, workings 3. So when you are writing this manually, you can actually have notes here. So you should actually have notes here, so that we know that property, plant and equipment is note 2. Investment property, we didn't do anything like that. For this is going to be note 3. And then we also come to our statement of comprehensive income, and then I'll have my notes here, and for my notes I'll have, for my cost of sales is note 1, for my distribution administration cost is note 1, and for my revaluation gain, this is actually gotten from my property, plant and equipment, so that is note 2. Alright, then we continue to our trade receivables, which we have in our question to be 9330. Just for confirmation. So we have 9330, and we have our cash and cash equivalents to be 1190, and so I can add these together. So I'll have equals sum, and I'm gonna add these together, and then I'll have a sum of these two plus this. So that is the total assets for the year. I'll come here, and we have our share capital. Now, to be able to complete the equity portion, you should have prepared your statement of changes in equity. So quickly, let's go and prepare our statement of changes in equity. For the changes in equity, we are going to start with the balancing with the balance brought down figures. So I have my balance brought down, balance BD, and for my share capital, it is 20,000. For share premium, it is 430. For retained earnings, it's going to be 28,077. For revaluation surplus, it's going to be 3125. And then we have our total here, alt equals, and then I can enter. Then we go to issuance of shares. So if there is any issue of shares, so we have issue of shares, and we have been told within the additional information that there has been issue of shares. So during the year, the company issued 2 million shares for cash at 1.20. Now, in our trial balance, we are told that the cash, the ordinary shares, are valued at $1 each. So if it has been valued here at $1.20, then the 20 cents here is a share premium. That is the premium element of the shares we issued. So for our share issue, it's going to be 2,000. The 2,000, so it's 2 million. So that is, we are removing the 3 zeros, so 2,000 times the $1 share, and that is 2,000. And then the 0.0 is the share premium. So we are going to have the 2,000 multiplied by 0.2. Let me bring my equal to sign once again, and that is 400. And then we have that, so that is it. So that is it. And we also have, so I can bring my total here by copy the formula down. And then the next thing is dividend. Dividend also comes here. So if there is any dividend payment for the year, we are going to deduct that from our retained earnings. Remember that dividend is paid out of retained earnings. So if there is any dividend payment, we'll subtract it. So let's go to our trial balance and see if there is any. All right, so we have our ordinary dividends payments here as 1,000. So I'll come here, and that is paid out of the retained earnings. So I'll have my 1,000 here, and that is going to be a deduction. So it's a deduction. So I'll have that, and then I can copy it. So I can come here, and then I can copy the formula down. And then the last thing we add is a total comprehensive income, TCI, total comprehensive income. So the total comprehensive income can be found within the our statement of profit or loss and other comprehensive income. Now the total comprehensive income is made up of two items. We have the profit for the year, and then the revaluation surplus. So the profit for the year will be added to our retained earnings, and then the revaluation surplus or the revaluation gain will be transferred to our revaluation surplus as we have it here. So we have our retained earnings taking the profit for the year. So I'll go to my statement of profit for the year here, and then the revaluation surplus, the revaluation gain will also come here, so that we have our total here, total comprehensive income, to be that figure there. So we are done. All you have to do is to add everything together. So I'm going to have alt equals, press enter, Then I can copy my formula to the right using Control R. So we have these figures that we are going to use to populate the equity portion of our statement of financial position. So I have here, and then for my share capital, I can link it to this place. For my share premium, I can also link it to my share premium is 830. For the next one, it is 30 and 8. For the next one, it is 7125. So we have it there, and then I can actually add them together. So alt equals, and then we have that figure there. Let me insert a border. Do it. Then we have our 7% loan notes, which is 18,250. Nothing has changed about that. So this is actually the column. Paste it there. And then we have our trade payables. Trade payables is in our question, and we have it to be 8120. We have our income tax payable, and that has been given to us. That is the income tax expense for the year, and that is equal to 976. And then we also have our interest payable. Now we have an information on our interest, which is the 0.5. The 7% loan notes are 10 years due for repayment by 31st March 20x7. Interest on these loan notes needs to be accrued for the 6 months to 31st. So it is only 6 months or half of the interest on the loan that is supposed to be accrued at the end of the year. So what that means is that we calculated our interest in the statement of profit or loss to be 1278, and this amount, half of it is outstanding at the end of the period. So we'll come here, and then I'll write, I'm going to refer or link this particular figure. This is not supposed to be a negative figure any longer, and I'm going to multiply that by 0.5. That is half. So we have 639. So sorry, supposed to bring these figures to the first column. So they're supposed to be here, so that the total can be here. So I'm going to have alt equals, and then I have that. We can now calculate the total equity and liabilities, and that is going to be equal to this plus this plus this, and there we have it. So I'll bold in it, and then also insert my border here, and I can bring my two double borders. So I'll come here, top and bottom. Voila, we are done with the preparation of the financial statements in accordance with IFRS. So what we have covered in this video is very key to you understanding how to apply the IFRS standards when preparing your financial statements. So what I want you to take from this video is that whatever issue or whatever item that you want to deal with within the financial statements, each of the items are actually they are actually treated under a particular standard. And so to be able to get going with the preparation and presentation of financial statements according to IFRS, then you are supposed to familiarize yourself with some of the popular standards, and I mentioned that already. So thank you very much for your time, and I hope you have learned a lot in this particular video. I'll see you again in the next videos. So I'm actually beginning a series on consolidated financial statements, and I have already posted the introductory video. I'll be continuing, so make sure you have subscribed to the channel, and I'll see you again in my next videos. All right.